Really wonderful opening to the forum today from Governor Doss. Very much appreciate him joining us. I'm going to quickly introduce our next panel. The panel title is Reexamining the Regulatory Landscape. So we're going to get into some of the financial stability risks that Governor Doss outlined and talk about some of the reform priorities, regulatory reform priorities. A man who needs no introduction to my left, UBS Chairman Colm Kelleher, of course. Also a long and distinguished career at Morgan Stanley. Thank you, Colm, again for partnering with us to co-host this event. Very much appreciate you. We have to his left, we have the Managing Director of the Monetary Authority of Singapore, Governor Chia Jiun, Managing Director, previously Permanent Secretary of Development at the Ministry of Manpower. Thank you so much for joining us today. Appreciate having you. And at the end, we have Bill Dudley, who is the chair of the Bretton Woods Committee and also the former president of the Federal Reserve Bank of New York. So thank you all for joining us today. Why don't we get into it a bit? So maybe just following that opening from Governor Doss, where he sort of outlined some of the kind of macro outlook and some of the global financial stability risks. Maybe we'll take a bit of a regional perspective, and since we're in Singapore, I'm going to start with you, Jiun. Could you maybe share a bit about your outlook for Singapore, Asia at large, particularly as it relates to financial stability?
Sure, thanks very much. And first off, just thanks to UBS and the Bretton Woods Committee for this invitation. Great panel, happy to be here. So first off, I would say that I would characterize the situation in this part of the world as macroeconomic normalization. But then I'll come to a second point, which is I think there is some denormalization in trade and investment flows. But let me come to the first point first. Singapore, I think we're expecting growth to come in 2 to 3%. It's been relatively positive so far in the latest months on a year-on-year basis, coming in stronger at the upper end of the 2% to 3% range. So a full year, we think it'll finish quite squarely within that range, probably on the stronger side. Then inflation is also coming down nicely. It's now on the latest reading, it's now come down on core inflation to 2.5% on a year-on-year. Full year, I think will be on range as well. And towards the end of the year, it should move, and into next year, move towards the range that we've been historically comfortable with. Growth has been supported, quite broad-based. Manufacturing is now stabilized. It wasn't a positive spot for some time, but now it's stabilized. We're getting some pickup from the global electronic cycle. But growth has been stronger really on services. So the comms and technology services have been quite strong, including the export of these services, and financial services have been quite strong. And underpinning financial services has been quite strong growth in asset and wealth management, and also quite broad-based growth in banking and insurance. So that's for Singapore. Cyclically, we're not in a bad place. That seems to be the same story for Southeast Asia. Inflation has really come back within targets for most countries already, and growth has been relatively good and near to potential. So they are in a good part of the cycle, and I'll just say that the recovery for Southeast Asia and the disinflation process has been quite remarkable if we look at it a little bit more closely. They peaked lower than the advanced economies, around 6% or so. They peaked earlier, and the disinflation process was achieved without the dislocations that we saw earlier in the 2013 taper tantrum. So the interest differentials that they had, of course, they had to follow monetary policy up with the rate hikes in the advanced economies. But the interest differential was relatively narrow relative to the taper tantrum. And of course, the currencies were allowed to be flexible and to adjust, and with some FX intervention to stabilize the currencies. There was also, the weakness was a fraction of what it was in 2013. So all said, this disinflation process, a benign growth environment was achieved with relatively low cost and with quite remarkable stability. And you can probably attribute this back to much sounder policy frameworks and macro outcomes in Southeast Asia. The fiscal deficits have really been quite well contained, and the current account balances have broadly been stable and balanced. So there are a few other reasons. I won't get into those, but generally, I would say that we're coming into balance, and it's coming into normalization. Then very quickly on what we're seeing on trade and investment flows. I think we've all heard about the China Plus One strategy. I think it's coming through the data. We're seeing that already. So if you look at the trade data and investment data, that's coming through. So some of that. The corporate strategy is really now thinking about building capacity outside of China to supply the rest of the world. And key beneficiaries in Southeast Asia have been, of course, Vietnam on a broad-based basis, but also for Malaysia in the electronic space, and then for Thailand and Indonesia in the EV battery auto space. So those investments are coming through. And Singapore is playing a role in intermediating these trade and these investments and the financing that results from it. So that's broadly what we see.
Thank you very much. Bill, I'm going to turn to you. Do you want to give us a bit of your view on the U.S. outlook and risks?
So the Fed has two objectives, dual mandate objectives. Not all central banks have two. A lot of central banks just have inflation, but the Fed has two, inflation and employment. And what's happened over the last few months is that these two goals have come into much better balance. The Fed's made a lot of progress on inflation. Inflation is running about 2.5% year over year. And the labor market has actually started to slow down a bit. And we've seen a rise in the unemployment rate from 3.5% up to 4.2% currently. So the dual mandate goals now are in balance. In fact, you could actually argue the risks to the labor market are actually greater than the risk of higher inflation. And so that basically is telling you that monetary policy no longer needs to be tight, it needs to be neutral, and that's why everyone knows that the Fed's going to cut rates next week. But we don't know how much, and we don't know how fast, and the uncertainty actually increased over the last 24 hours because there was an article in the Wall Street Journal and in the Financial Times almost at the same time, which basically said, is the Fed going to go small or is the Fed going to go big, 25 or 50 basis points? I'm totally confused at this point because I think the case for 50 basis points is actually quite compelling. If you need to be at neutral and you're at 5.33% on the federal funds rate, nobody thinks neutral is above 4. So you're at least 150 to 200 basis points away from neutral. So the question is, why don't you just get started? So we'll see what happens. I think what the articles that you read in the journal and the FT are basically telling you is it's still an open question, and it's basically up to Chairman Powell to see how much support he has for being more aggressive. Because if you go back to his Jackson Hole speech, he was pretty clear on what he wanted to do at this point. He basically said the mandates are in balance, and he said he didn't want to see any further weakness in the labor market. Well, if you don't want to see any further weakness in the labor market and monetary policy is tight, then you should get started. So I think at the end of the day, it's really going to be about his decision about how hard he wants to push the committee, and that'll determine whether we get 25 or 50 basis points. It's very unusual, though, to go into the meeting with this level of uncertainty. Usually the Fed doesn't like to surprise markets. Part of the problem, of course, is we're in an election cycle, so that makes things more complicated. And part of it is they actually have to publish this summary of economic projections and show what their interest rate reductions are for the remainder of the year, which is actually a little awkward. Because if you do 25 this time, are you going to show 25? You're probably going to show 25 for the next two meetings. That's only 75 basis points when the market's actually priced for 110. If you do 50 this time, well, then what are you going to show for the next two times? So the fact that they have to disclose what their interest rate projections are over the remainder of the year actually are also making it more complicated. The big risk for the Fed is that the labor market continues to deteriorate. There's a rule in the U.S. called the Somm rule, named after Claudia Somm, which basically says that every time the unemployment rate moves up by more than 0.5% on a 12-month moving average basis, you end up in a recession. And the next stop is not 0.7% rise in unemployment rate or a 1% rise. The smallest increase after 0.5 is 1.9 percentage points. Now, people are arguing that this time is different because the Somm rule has been tripped. That trigger has been tripped. And they basically argue that the rapid growth of the labor force is the reason why the unemployment rate is going up, not job layoffs. So it might be different this time, but I always get a little nervous when people say this time it'll be different.
So the case for 50.
I think there's a strong case for 50, whether they're actually going to do it or not. I know what I'd be pushing for.
Okay, let's turn to some of the issues that the panel is titled, and focus on some of the risks, particularly in the banking sector and some of the regulatory reform agenda. So, Colm, I'm going to start with you. I mean, the episodes in 2023, those were really the first, I think, real tests on the financial system since the Great Financial Crisis. You were at the center of the biggest deal last year. Tell us what your lessons learned are.
Well, I think the first lesson learned is that the too big to fail banks proved remarkably resilient because of the recapitalization of the whole system since 2008. The lessons were not about capital. To put it in context, capital for big banks is up 10 times. Total loss absorbing capital is up 20 times since 2008. So I think we're confusing the issue with what happened. What happened was we had an idiosyncratic issue of a bank with a substandard business model that was not regulated properly, in my opinion, and there are lots of reasons for that. And the issue was compounded by contamination from the states, where in the medium-sized banking sector there had been some regulatory forbearance, which compounded the issue. But clearly what happened is there was a solution, and the solution was another too big to fail bank. Now, first of all, I want to make one thing very clear. Somebody mistakenly said that resolution wouldn't have worked. That is totally incorrect. Resolution would have worked at the time. The problem with resolution is that it has contingent damage, and the market would rather have a solution other than have contamination. The two other solutions were a temporary public ownership, which could possibly work, although in the case of NatWest in the UK, that hasn't proven to be as efficient or as good a use of people's time as possible, or a private sector buyout. And in this case, UBS was the private sector buyout. So going forward, we clearly need to sharpen up on a few things. One, we must make sure that we have proper and robust recovery and resolution programs across the system. Two, I do think, and Bill has written, G30 wrote a very good paper on this, is about the need for incremental liquidity provision, right? Expansion of collateral pools and so on, so access to liquidity. And three, a caveat I would give is if you're going to have a private sector solution, make sure that you have banks who are strong enough to do it, but then don't post hoc punish those banks for doing it as well, right?
How's that going?
To be determined. But the fact that UBS was there, look, Switzerland wanted a two-bank solution. I fully understand that. But this argument that a bank in relation to GDP is just one measure is a very false argument. What UBS did do, aware of its social contract with Switzerland and stepping in to stand in for Credit Suisse, is we completely committed to a business model which was a much more liquid business model. We resized our investment bank and tried to give assurances that way. And I think that's what we have to do. The only message I would say here, and I'll be quiet, is I think the thing we've learned is that traditionally regulators were worried about stepping into the role of shareholders, i.e. the business model was the determination of the board and shareholders. I think what Credit Suisse has proven is that that was not a sufficient safeguard. I think regulators should be perfectly entitled to question the validity of business models and sustainability of business models. And that's a dialogue that I would welcome.
Thanks, Colm. I mean, your insights are, bar none. Bill, maybe following up on some of what Colm mentioned about the resolution framework. I mean, if it's not going to be used, why do we have it? And what needs to be done so it is used when the opportunity is presented?
So I think you need a resolution framework because that's your sort of fallback. I mean, there's not always going to be a healthy bank there to merge with the not healthy bank, because it might not be a problem that's just idiosyncratic to one institution. It could be much broader. Like, for example, during the Great Financial Crisis, merging two weak banks together wasn't going to really sort of solve the Great Financial Crisis. So I think the resolution regime, it makes a lot of sense. We have to recognize that the resolution regime can't cure all ills. If a bank is poorly managed, it has an unsustainable business plan, if people have lost confidence in that bank, putting that bank into resolution isn't going to fix that unless you actually change out the management and change out the business plan. So, resolution was always designed about making sure a bank has enough capital. Capital is a necessary condition for a bank to operate, but it's not necessarily sufficient. I think the second lesson, what happened in March of 2023, is that we found that deposits run much faster now than anybody ever anticipated. It's partly through social media. In the U.S., it's probably because there were some very large depositors at Silicon Valley Bank. Probably too large depositors, too much of a concentration of deposits. So what we really do need to do is really bolster the lender of last resort function of the central bank. And what the Group of 30 report has proposed is to require banks to post collateral at the discount window, a broad set of collateral, not just treasuries and mortgage-backed securities, but loans and pretty much everything that's in their portfolio. Because if people pledge sufficient collateral to the Fed to backstop all their runnable liabilities, all their uninsured deposits, those uninsured depositors wouldn't have a reason to run in the first place. So you sort of take away the whole panic prospect. I think in Switzerland, I think the Swiss National Bank lender of last resort function needs to be broadened. They actually have a pretty narrow set of collateral that they actually accept at their lender of last resort function, even though there's plenty of very safe assets in Switzerland. You look at the loss rate on residential mortgages in Switzerland, it's like de minimis. So why not take those mortgages as collateral for lending? So I think working on the liquidity side, I think makes a lot more sense than working on the capital side. I mean, I think, if you look at the U.S. reflectively, right after the Silicon Valley Bank failures, the Fed came forward with a Basel III endgame, which was a big increase in capital on the biggest banks, and a much more modest increase on capital on the regional banks that were actually in a difficulty. So it was really sort of off point in terms of addressing the problems of the crisis. Now the Fed has sort of gotten religion, so that the past week they basically dialed down the incremental capital substantially from what they had originally proposed, and I think that makes a lot of sense. I think putting too much capital requirements on banks doesn't necessarily make the financial system safer. Because if you raise the capital requirements on banks, you're making banks less competitive, and so you're pushing activity out into the non-bank financial sector. And the problem in the non-bank financial sector is the regulators don't have a lot of visibility. They don't know exactly what's going to happen. They don't know how resilient that sector is to shocks. The goal shouldn't be about making banks bulletproof. The goal should be making the financial system as stable as possible. And so you need to have a balance in terms of how you regulate banks. There needs to be sort of a carrot and a stick approach.
We're going to come back to some of the non-bank issues in just a moment, but I want to give Managing Director Chia a chance to respond. So, you watched these kind of episodes play out in the U.S. and in Switzerland. What was the sentiment here in Asia? I mean, we know that it was contained. There wasn't a huge global crisis like there was in 08, 09. So what were the lessons here, and sort of what was the policy response?
Yeah, thanks. We're very keen learners in Asia, so we watch this quite closely. So, I agree with Bill's point that liquidity is important. I think I'll add to this with saying that we have to watch the intersection of liquidity risk and capital risk to capital. So clearly, the liquidity risk in terms of how quickly a run can happen and the scale of the run, that I think we all have to go back to the drawing board and re-examine old assumptions, right? So clearly, the digitalization of banking services has gotten to a far greater extent now, and the spread of information is really, really quick. And some of that information may not even be accurate. So with that in mind, re-examining liquidity risk assumptions is critical. I would say stress testing. Go back, re-look at the assumptions. We've got to look at the held-to-maturity assets, and that was a key issue in the U.S. example, for instance. And looking at how different parameters could affect those assets. It was interest rate risk this time around. It could be something else next time around. But that's where the intersection of liquidity risk then hits capital. So we do have to look at those. I would say stress testing, the scope of it, don't reserve it only for the largest institutions. I think you have to stress test quite widely. The second thing I would say to this is in terms of business model, risk to business models, which was also Colm's point. And then I think increasingly what supervisors are talking about is culture and conduct risk. So in business models, it's a tricky area for supervisors to get into. This is the responsibility of board and management to get the bank's business model right. That's the responsibility of board and management. What can supervisors do, right? So I think we've increasingly gotten into the space. The Basel Core principles have now been revised to say it is an area that supervisors do need to get into, but how to get into. You don't want to get too intrusive. Business direction has to be set by the bank, but you can challenge assumptions. How robust are these earnings? Where are the points that are going to come at it that could derail some of these earnings? Are you gaining customers? Are you losing customers? How robust are some of your risk assumptions? So I think on all these points, there can be challenge. And this is quite closely related to culture and conduct work. Again, this has, in the last several years, has become more widely accepted amongst supervisors. Still early stage, but so in MAS, the journey started 2020 or so, and we issued a paper with some principles around it, so 9 points around culture and conduct. And the key again is to look for alignment. So if this is your strategy and these are your risk appetite and what you say are your risk strategy, how does this align with practices, with what you're saying? What is the tone from the top? And what are managers and leaders saying in the organization? Are they practicing what these risk parameters and appetite and statements are from the board? So looking for that alignment, have a challenge process, I think will increasingly become important.
Can I just add one thing to what you said? I completely agree with the conduct and culture. And at the New York Fed, we started a program about a decade ago, really focusing on this. I have a very simple explanation of how important it is. Incentives drive behavior, and behavior drives outcomes. So if you don't have the right incentives, you're not going to get the right outcomes. And I think it's really, I think that's one thing where regulators can really make sure that the incentive system is aligned with the outcomes that they seek, which is provision of financial services on reasonable terms, but also resiliency against shocks.
Colm, any last things?
Well, it's everybody. Governor Tarullo, of blessed memory, realized in 2009 that those banks that had withstood 2008 best were the banks with strong cultures. Exactly your point. And he tried to work out from a regulatory point of view, how do you lay down a code for culture? And it's very difficult, right? It is about alignment of risks, incentives, compensation. It is about tone from the top. It is about, you know it when you see it. From a regulatory point of view, you look for early warning signs on culture. You look at turnover of staff. You look at forgiveness of bad behavior. You look at a million things. But it's a challenging thing for you to know how to codify that. I mean, we would like to work with you on that, but codifying it is very tricky indeed. Yeah.
Maybe just to sum up the conversation, I think different drivers of the two crises a bit in 23 require different looks at the reform agenda, and they need to be fit for purpose.
Absolutely. To identify what actually the problem is and then mobilize tools to address that problem rather than just reactively think everything is a capital problem and try to hit it with a hammer.
So maybe we'll move to some of the non-bank risks, since I very much agree, Bill. I think it's about the international financial system as a whole. As we've sort of talked about, as search for yield and new technologies move investment outside of the banking sector and into non-banks and outside of a regulatory perimeter. I mean, Colm, where do you see the biggest risk concentrating in the non-bank?
Look, I got in trouble 2 years ago at the Hong Kong Council for bringing up this issue of, they said private credit, but I was talking about a broader issue. In the desire to downsize the banking system post-08, a lot of business left the banking system because of increased regulation, increased capitalization, and so on. And at the time, some of us pointed out that there would be lack of visibility into that risk. And we were told then unequivocally that was a risk that regulators were prepared to take, right? I think what's happened now, if you look at the FSB and you and others, They now understand that this is a growing problem. Now, for the record, I am not trying to put the degree of regulation on NBFIs that banks have. Banks deserve a higher standard of regulation. We are deposit takers and so on. But the numbers are quite telling. Non-bank financial intermediaries now account for 50% of world financial assets, up from 38% in 2007. You're talking about a population of approximately $220 trillion. Regulators do not know necessarily what that risk is, right? So, do I think there's systemic risk in there? No, I don't. I think there's fiduciary risk, but we can argue that. And you can see areas, so let me give you an example. The banks did not adopt crypto because it was not in a form that we were comfortable with or the regulators were comfortable with. Crypto at its peak before the recent run-up got up to about a $3.8 trillion market capitalization. It collapsed to about 600 billion. There was no effect in the banking system on that because it had not been brought into the mainstream. But in the non-banking system, there was serious losses taken. Now, were they systemic? No. Did it cause huge loss? Yes. Does that tip a possible fiduciary crisis? I think it does. So that's my issue, is that there are sectors there where we don't understand. The argument is these are not retail investors, there's no leverage. Both of those points are fundamentally untrue. There is retail participation in that sector via other conduits, and there is hidden leverage. So my argument is that I'm not saying regulate it, but know what the risks are, and that's what the regulators, I think, should be focused on.
Yeah, Bill?
Yeah, I mean, I agree with what Colm said. I mean, I think, you know, the big issue in where you really get in trouble in the financial system is when you have long-term assets that are financed by short-term liabilities. And one way the non-bank sector has done a pretty good job on is they have the ability to put up gates so that people can't get their money out quickly. So that sort of avoids the fire sale of assets. But we don't really know for sure that these gates will always really work well. And we don't know if the gates go up, what happens to the person that was expecting to have liquidity from the non-bank financial sector, and that liquidity, those funds are no longer available. One example which I think is crazy, and I'm sort of surprised that regulators haven't done something about it. High yield bond mutual fund, granting the investors in that overnight liquidity. That makes no sense whatsoever. The assets aren't that liquid. The fund could not liquidate on a one-day basis. Why not basically require the mutual fund to have it be 1 month liquidity or 3 month liquidity? Anybody who's in a high yield bond mutual fund because they need cash tomorrow is probably not being a very wise investor. And I think it's important to put up guardrails to prevent people from having expectations that might not be realized in practice.
I'll just add quickly that the migration of risk from banks to non-banks has been happening for a very long time. Certainly it picked up after the global financial crisis. And the initial phase of that, I think we were looking at, and these structural changes are still happening. I think we're still trying to understand the risk. So apart from credit risk being the latest migrating into the non-bank space, market risk has migrated for a very long time. We're still trying to understand the full implications. Certainly, we know that dealer inventories have come down across a raft of assets, and how this intersects with periods where there is market volatility and the thinning out of markets. So I think we're still trying to understand the full implications of it. Has it been highly precipitous? No, not yet. These periods have been relatively transient. So, but it still, I think, behooves on the global regulatory and central bank community to continue to study the space quite carefully. Now, the latest, I think, is migration of credit. I think we would do better to try to understand this much better, what is happening. Now, if there is, risk transformation or maturity transformation, I think the Bill made these points. I think those certainly would be clear cases where regulators have to take a much closer look to see if those models are sustainable.
I mean, one good thing has helped us is, in some ways, we had this huge forest fire in 2007, 2008, and it cleared away a lot of the, sort of not very strong structures. And it takes time for the financial sector to invent new bad things. So I think I think there's a risk that we're creating some bad things that we're just not aware of yet because the system hasn't been shocked in a particular way. But I think the financial crisis is partly the reason why things have been pretty good since then, because everything that was really weak was swept away or fixed. I mean, a good example is central clearing of over-the-counter derivatives. That's been a huge benefit to the system, and that happened because of the great financial crisis. So that's reduced risk in the system substantially. And I have to say, CCPs have actually, I think generally worked better than I would have expected. In sort of the 95% distribution relative to what I was hoping for when we actually set that in train.
Bill, I want to ask you to talk a little bit about the BWC report that we are releasing today on sort of global liquidity fragility. I mean, one of the big findings in the report is this move to the non-bank financial sector. The report comes up with some recommendations on what central banks should do to sort of shore up some of those vulnerabilities. You want to talk a little bit about that?
Yeah, I mean, Dick Berner and I've worked together for a long time. He was actually my boss back at J.P. Morgan so long ago. I don't want to share that information. Yeah, so this is a report that looks at liquidity, but not just liquidity in the banking system, but liquidity on a broader basis. And the report, I think, endorses the Group of 30 recommendation about the pledging more collateral to the central bank to backstep the uninsured liabilities, but it also looks at its other sources of liquidity provision. For example, what's the role of the central bank in terms of supporting market functions? For example, in the United States, the Treasury market has gotten absolutely enormous. The CBO just announced, I think today or yesterday, that the budget deficit for this year is going to be $2 trillion in the United States. And the capacity of the primary dealer committee to, intervene in that market is not kept paced. Also, the market is the main market makers in the U.S. Treasury market are high-frequency algorithmic traders that don't actually have any capital, and at the first time of trouble, they just sort of withdraw from the market. So, the Treasury market's another, sort of example of where, who is actually going to backstop that market in times of stress. Now, we saw during the COVID pandemic, it was the Fed. The Fed came in, very, very forcefully in 2020 to support the U.S. Treasury market. But you'd like to have a regime that was a little bit more known a priori as opposed to ex post. Not knowing exactly when the central bank's going to intervene, how they're going to intervene. I think that leads to more, potential volatility than having a regime in place where people understand what the rules of the game are.
Yeah. Maybe just one or two words. I think this is an evolving space, and central banks would do well to look increasingly at market functionality. Key linchpin markets like the U.S. Treasury. I mean, we had the incident in the gilts markets, of course, a little time back. And in terms of thinking through the support given to non-banks, I think it is a new area and well worth looking into in very selective cases, contingent circumstances. And I think even outside of these key linchpin markets in the advanced economies, even in Asia, I think we have to look increasingly at the speed or response of central bank facilities. So the timeliness and the speed and the extent of the collateral, we have to increasingly look at widening that collateral that we will accept, and then the flexibility in terms of the conditions and the term that we would attach to those facilities. So I think liquidity risk is something that has to be on the agenda, and we do have to look at the central bank response.
Maybe sticking with you, Jiun, we talked about some of the risks, sort of non-bank risks and regulatory response, but let's talk a little bit about technology, innovation, digitization. MAS is really at the forefront of being, I think, one of the most friendly central banks to encourage innovation, but has a really clear, articulate kind of strategy to maintain financial stability and regulatory guardrails. You want to just share a little bit about how you view that?
We're friendly to well-supervised innovation and risk-taking.
And not friendly to the others.
I think the key is to avoid the two extremes. We don't want to snuff things out before they had the chance to grow, and neither do we want to let it grow uncontrolled, and then the risk when it precipitates is disastrous. So certainly we want to avoid those extremes. I think the approaches that we have taken have evolved. In the early days, I think if you look back 8 years, 10 years, Sandbox was the main instrument that many of us were using. Certainly in Singapore, we were using sandboxes. And the idea was really, this is a new business model. It may not comply fully with regulation today, or it may have risks that are untested and quite unknown, and we need a mutual discovery process. Let's put some parameters around it. Let's experiment with it. So you don't grow too quickly, too much too quickly. At the same time, there's time for us to understand the full risk and for you to play out the implementation of it. And it has worked quite well. I would say the success rate was of graduation from the sandbox into obtaining a full license was 75%. Now, in that success rate, I thought that was a good indicator, because it does mean that we're prepared to allow things to fail. We're preparing to allow models to fail. So if we had been very stringent in admitting business models into the sandbox, we would be targeting a 90% success rate or more. But we were prepared to have a slightly longer leash and have a slightly higher failure rate. I think 25% is not a bad thing. And in the end, there were no precipitous events because the guard railing was quite robust, right? So that was sandboxing. We have now, I think, moved on a little bit in our approaches. So now increasingly we're taking collaborative approaches with industry, consortium that form. So we've done this in a number of areas. So in the area of AI, for instance, started quite early on. I think, again, if you look back 7, 8 years, when we came up with principles governing AI, how financial institutions should think about it and apply it and govern it within their organizations. Again, that was a collaborative approach. It was co-created, right? So these were the principles. Now, fast forward to this, and then we're looking at the implications of Gen AI. Again, the same collaborative, consortium-led approach. First, with Gen AI, I think we're all still in a learning process. So the idea was bring together financial institutions, the regulators at the table too. Let's collectively look at this. So we started taking this apart, right? So let's look at the life cycle of the model, right? From the data collection to the data governance and processing and the cleansing, that whole part of the chain, down to the model building, down to the model evaluation, validation, and the performance monitoring. So the whole life cycle where you would build and then deploy and then monitor the use of an AI model. Let's take a look at that. What are the risks? Let's just take it one step at a time. And then we came up collaboratively with the industry, a typology of risks. So that helps in leveling up understanding and having a common conversation across the industry on something that I think everyone is interested to really share and make common progress on. And the next stage to that, and this was published, right? And then the next stage now is to really look at governance around this. Now that we understand the risks a little bit better, how do we start thinking about our governance structures and approaches? And so this is the next stage of that collaborative project. Then I would say the supervisory guidance is one step behind that, because I think the mutual discovery in a new area, so new area of Gen AI, we're still trying to understand this as best as we can. And so the next stage, one step behind, is really that supervisory guidance on model risk management. And this will be informed by some of this foregoing collaborative work. So that's one example. So I'll take the other example of asset tokenization. So this has been tried on in many jurisdictions. We've done this as well. So now we've done 17 pilots on various asset class, 24 financial institutions participating across fixed income, FX, asset and wealth management asset classes. So looking at how this can have commercial application. And there has been small-scale commercial applications rolled out already, right? So we do have firms that are offering multi-currency settlement solutions for corporates. We do have securities issuances into blockchains. And we do have cash and treasury management products that are out there on blockchain. So it is happening, but not at scale, right? So the next stage of this collaboration is really to bring together these problem statements. Okay, you've tried this out. Why is it not scaling? What do we need? Answer has been, well, we need a little bit more standardization, right? So this is probably the same in any asset class at the early stages of it. And so now the collaboration with the industry, with the regulators, and we've brought in other regulators, so it's cross-border, right? So international financial institutions, MES is there, but we've also brought in partner policymakers from other regulators to take a look at now what needs to be standardized across the documentation, the regulatory compliance, the legal liability assignments and duties, and also some of the technical areas that need some alignment. And so these have to be worked at fundamental levels, at the chain level, but also at the asset class level. And this is the kind of work that we're embarking on.
Maybe one final question for Bill before I ask some audience questions. Bill, how do you view the MAS approach to technology and innovation comparative to the U.S. approach?
I prefer the MAS approach by a wide margin, because it's much more proactive and it's much more willing to basically learn, put up, and has guardrails. I mean, the U.S. basically doesn't have guardrails and it's not very proactive.
And territorial.
And the U.S. is a pretty important player in this market. With the dollar as a reserve currency in the world, I mean, you sort of want the U.S. to be sort of a little bit more forward-leaning in this process. And I think the honest answer is that they're not. It's not clear exactly why. Maybe it's if you are the leading reserve currency in the world, maybe you want to be very cautious because you don't want to mess up that status. But I think the MAS approach, I'm a big fan. I think it's the right way to go.
Bill, on that, it's also in the US, there is a question of who's responsible for what. There is that.
Well, it doesn't help. Yeah, it doesn't help that we have a CFTC and a SEC arguing about what is something a commodity or a security. And then we have the banking system where we have regulators. We have the FDIC, the Office of the Controller of the Currency, and the Fed, plus 50 state banking regulators. So, we do not have a very consolidated financial regulatory regime, which I think it makes it harder to make progress. I mean, I think the thing that's disappointing me about the Fed, frankly, in this particular case is there have been some DeFi, fintech companies that have made application to the Fed to try to get access to a Fed account, which would then allow you to backstop things like stablecoins with central bank reserves. And the Fed has been very reluctant to approve any of these applications. So it's a little hard to sort of see what the future looks like if you can't actually, backstop the stablecoins with a really safe asset.
Yeah, it's quite the complex system in the U.S. We don't know who's responsible for what.
I mean, it's capitalism is messy, I guess.
All right, I want to get to some of the audience questions,
That's
and maybe Colm, I'll start with you on this one.
Capitalism is messy.
The question is,
book.
you talk a lot about the transfer of risks from bank to non-banks, and we've talked about some of those possible issues, but maybe articulate your view on sort of the balance between the risks and the benefits that the non-bank sector brings.
The non-bank sector brings huge benefits and a huge different type of management of risk. So I don't challenge that at all. That is not the issue. Clearly, the growth of alternative asset managers allows people access to products that they wouldn't normally get. My issue is purely about the monitoring of risk itself, right? So I'm not challenging the non-bank sector. There are certain products, Volcker was absolutely right, that should not have been in the domain of the banking system. And that's moved out into the hedge funds and wherever else, and the incentives have followed that, and we applaud that too. But Bill touched on this, there is a presumed liquidity in the non-bank sector, which is not there. You've only got to look now at the sheer amount of secondary trading in LPs, limited partnerships, which is not actually what it's meant to be about. So in many ways, let's call a horse and describe what it is. The banking system permits liquidity, protects depositors, and gives a return within a well-regulated regime. The non-bank system gives risk at a price that people should know what they're paying for.
Yeah.
I mean, I just say trust in the financial system is absolutely paramount for the financial system to work properly. When trust is impaired, you have all sorts of problems. And transparency is important, but you can't expect the average citizen to sort of, study a financial firm's balance sheet to understand the risks. So this is why we have deposit insurance to protect. That's why we have bank regulation. So I think, there has to be a little bit of horses for courses. You don't want people that are, not unsophisticated who go to start playing around with financial products that they don't fully understand. Because if there is a shock to the system, they're going to be surprised. And not only is there going to be a problem in that particular sector of the financial system, but that shock can also undermine trust in the system more broadly. So I think it's important to make sure that people understand what they're getting and what the rules of the game are on an ex ante basis.
Just a quick word about benefits and risks of the non-bank sector. I think we've seen the non-bank sector really step up in terms of being liquidity providers in a lot of key markets. Certainly in the FX markets, they are, very, very important. But these are two sides of the same coin, and I think we do still have to understand the evolving embedded risks in these. I think it's much talked about a little bit at a conceptual level, that there is the potential for herding behavior, for algorithms to behave in the same way under stress conditions. And that seems to come up now and then when there are episodes of liquidity stresses in some markets. So it is an area we do need to keep a watch on and see how that evolves, especially now if you layer in the use of Gen AI models. Now, if Gen AI foundational models are also being used to build and refine trading and hedging models, we'll have to better understand how that's going to work. And I think it's been spoken of conceptually already that there is a high reliance on 2 or 3 really foundational Gen AI models across a lot of corporate applications, certainly in the financial industry as well. And whether that concentrated reliance on a few models will mean that trading models themselves are going to behave in a herd-like fashion. I think that's a conceptual point that's been made. We'll have to look at that empirically.
I agree with that. I mean, there's a risk that you lose diversity.
Yeah.
And if you lose diversity, you lose resilience. And that's one of the things I worry about, that everyone sort of will converge to the same perfect thing. Remember, AI is all backward looking. It's not forward looking. It can't reflect changes in the regime that have just occurred. It's always based on data in the past. So if everyone's looking at how the past performed and there's a new innovation in the system, AI isn't going to do very well. And if everyone is relying on exactly the same AI model at the moment, you could actually have a pretty big problem.
Sticking with some of the innovation, one of the questions that came in is on public blockchains, and I think maybe this one's for MD Chia. It says, what are the conditions that would give regulators comfort for banks or well-regulated NBFIs to build on public blockchains?
So I think we've done some work on this, and we've published on this as well. So I think there's been the early stages of the work has really been on about public permissionless blockchains. That's a lot of the crypto development that's been happening. Clearly, there are vulnerabilities to these crypto models. I think the vision that us in discussion with the financial institutions have been talking about is really moving towards public permission blockchains. And so these are much more well controlled. So I think if you take an example, an analogy to this, is that if you look at, if you compare, say, the future of tokenization on blockchain to the internet is borderless, is permissionless. Anyone can get in or out, any content. So if you take that as an analogy, then that's a public permissionless blockchain. But you can have a different vision of this, and increasingly this is coming out in our discussions with financial institutions on how they see this. Potentially you could envision it in a different way, which is we don't want to go down the path of walled gardens, right, where people sew up the community to themselves and there's no interoperability. So that would fragment liquidity, and it would make price discovery much harder. It would make for a very inefficient financial system. But you can think in terms of a gated community, potentially a network of gated communities that have these key nodes connecting them. And the important thing is that if you think about blockchains and how to build trust in this system, and trust is essential because that's the underpinning of the current financial system. And the key trust pillars are the central bank, the regulator, and well-regulated financial institutions. These are key pillars of trust anchors. Now, if we think that into the blockchain world, an asset tokenization world, how do we really impart the same level of trust, and how do we create these trust anchors? Now, we have to think about those too. So then you get into the space of, let's think about permission. Public blockchains are useful. They are out there, the infrastructure is there, and the community is improving it all the time. So it is a useful infrastructure, but perhaps on a permission basis with well-regulated gateways that can decide and determine which well-regulated products can be put into the chain and which are the intermediaries that will have to play a key role in terms of underscoring and underpinning the trust that's necessary for Liquidity to build and scale on blockchain.
Bill, I know you've been thinking about this a bit recently. Any additional?
Well, I thought that was
comments?
a very excellent answer. I mean, I mean, I think this issue of scale is really, really important. I mean, you know, there's huge scale economies in, you know, any sort of payments kind of regime, and you know, the question is how you get those scale economies. I mean, I think what's happening, you know, what the BIS is doing, we'll get into this a little bit in the next session, is doing in terms of Project Nexus is actually quite interesting, where you're basically sort of say, we're going to take individual national regimes and we're going to have an interface that connects them once, sort of in the hub. Everyone connects to the hub, and then they can connect to the other regimes is a much better way of trying to think about scaling than each system having to bilaterally negotiate terms with each of the other systems that exist. So I think that's, you know, that's probably the right way to go, and I'm pretty happy to see what the BIS is doing in terms of, you know, sort of outlining a vision of how this could all materialize. Now then you have to get sort of a corporate structure, you have to have someone that actually is running this process, and then there's also, you know, the question of like, well, who are these people, who appointed them to do this? So there's a lot of work involved, but you know, we've gone down this road before. I mean, if you look
As long as you don't create an oligopoly.
yeah.
And that's,
yeah.
that's the risk.
Yep.
So.
All right, I think we have time for one or two more questions. Maybe Bill, can you give us your take on U.S. recession fears?
Well, yeah, I talked about that a little bit earlier, that when the unemployment rate goes up by more than a certain amount, it usually goes up quite a bit. And you know, the reason for this is really very straightforward. People hear that the labor market's deteriorating, and so they basically say, you know, that car I was thinking about buying, I think I better sort of wait on that. Think about that new furniture I was going to buy, the home remodeling I was going to do. I think I better wait on that because I hear that the labor market is deteriorating. What does that do to the economy when everyone starts to wait? It makes the economy weaker, people lay off more workers, and the whole process sort of keeps going. And you know, the problem for monetary policy is that there are long lags from monetary policy in terms of it's actually supporting the economy. So by the time that the central bank sort of registers that the economy is weaker than what they desire, it takes time for the monetary policy easing to actually work its way through the system. Now, I don't know that the SOM rule threshold of 0.5% is going to work this time. That threshold was set based just on what worked historically. So it's really, as Chairman Powell said in a press conference, it's a statistical regularity. But what's interesting to me is this gap. The fact that if it goes beyond a certain point, the next stop is a much bigger number. That to me tells you that there's a real, you know, discontinuity in how this whole process works. So I think, you know, when I'm thinking about the U.S. economy over the next few weeks and months, I'm going to be very much focused on the labor market. Weakness in the labor market will make me much more concerned that we're now entering this self-reinforcing period. And if the labor market, you know, holds up reasonably well, then I think the Federal Reserve could generate a soft landing like they did in 1995. But soft landings are actually very hard to find. If you go look at the U.S. experience from 1960, 1995 is basically the only sort of soft landing that the Federal Reserve has pulled off in that. So that's what, you know, over 60 years. So hopefully hopefully they'll do it. That's certainly what Powell is hoping.
Well, we're going to end with maybe a bright spot. We heard from Governor Doss. India has been a sort of bright spot in the economy. Colm, this question is for you. Does UBS plan to further expand in India now that it is a bright spot?
Well, the answer is clearly yes, but we don't know how yet. So we've got to understand it much better. I mean, there have been very many international firms with false starts in India, including my old firm, by the way. Obviously, India is strategically very important, huge growth area, but we have to do it in a considered, regulated, risk-adjusted way. So we're studying it now and working on that.
Great, thank
Thank
you.
you.
Can everyone please join me in thanking our panel?